All right, stocks fell for a fifth straight day today. Not very common to have that long of a losing streak over the last so many months, but obviously we are starting a little bit of an intermediate decline. Of course, as we've been talking about in videos and some of the classes that we do at Market Scholars, this decline is probably not going to be that much. Again, especially depending upon what's happening here overnight with the strikes that are going on in Iran, the 1% decline that we're already seeing in the futures. Though we're off the lows right now as we speak, and so the question will be, how much will we be down by the time the market even opens tomorrow morning, and then of course once it opens and volume starts to kick in, will there be a lot of kind of profit taking or short covering, so to speak? So a lot of that's going to be coming out here tomorrow. But I'm going to break down what our expectations is. Based off what the charts are telling us, based off the close, not including what's happening overnight, but just off the close of the day today. How long, how deep will this pullback be, and what can we expect in terms of when and how much it will bounce back up to the upside based off of some of the patterns we're seeing. So we'll take a look at that, what's driving this action. You can kind of see it's actually kind of interesting to see the rotation. It's not necessarily what you'd expect from a sector rotation standpoint. So we'll break that down. Again, that three-headed monster I've been talking about. We talk about maybe a fourth head that might be added to that monster. What's been rising, though. Again, all those factors are still out there in terms of impacting risk appetite or risk aversion, increasing the aversion to risk. So we'll break all that down. And then our trade idea is a stock that has, like many, has earnings coming up here pretty soon. So we'll talk about how to trade that in light of this pullback and in light of that upcoming earnings. So let's go ahead and get started. Today is Thursday, April the 18th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're watching this on our blog, check out some of these other things over here on the right, including in a Market Outlook live video where I review all the old Market Outlook trades, trade ideas to see whether we should stay in them, get out of them, talk about why. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers on those platforms. So we always ask. It's a big deal for us. Our goal is to get to 100 on these. So those who like this day in and day out, thank you very much for helping us get closer to that. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's go ahead and take a look at the S&P 500 with the market forecast indicator here. And you can see we closed the day with our first cluster. We closed the intermediate line closing in the reversal zone. Actually, we went from the 23rd percentile here all the way down to the 10th percentile. So not only did we get in the reversal zone, but we got way down in the reversal zone in one day. The short-term sentiment has been pretty oversold from now, 4 days down to pretty bearish low points there. Of course, again, all of them down. We're below the 2.5% mark or 3% below the moving average. Dark pink shading, the red line, again, still up there. So, again, clearly in an intermediate decline, have been now. We talked about this. So when I came back from my vacation, we talked about that actually occurred on my vacation on my spring break. That ended up being a bull tag on all the other indexes and kind of a quasi bull tag there that we never did get above that high. And then, of course, once we got below that low point, there we went, right? The Dow Jones obviously starting earlier and kind of giving us that precursor. We kind of talked about that too, right? Because the Dow Jones had started an intermediate decline, a few days earlier, that we expected everything else would kind of follow suit, and it ultimately, of course, did. We got 3 clusters in a row. Went for number 4 today. And we did have a cluster at the lows of the day today, but we finished up slightly because we finished up and we got up to actually a higher high at one point. It brought the momentum and the near-term lines higher. But still dark pink shading and a red line. We're still easily well below the moving average. Market sentiment's falling. For the SPX, market sentiment was still in the upper reversal zone, but just barely. Probably one more day, and it will be below there. The Dow Jones is obviously below. It's still in bullish territory, but it's out of the reversal zone. And the Russell's the same way. It's in bullish territory. It's falling, but it's obviously not in the reversal zone. And we got 3 clusters in a row here, and we're actually in the lowest 5% of how far away from the moving average we are. So we're pretty far away here at 5.25%. Dark pink shading and a red line. Your NASDAQ has been the most bullish. It finally got a cluster today as the intermediate line dropped again from 20 to below 10. Above 20 yesterday, below 10 today. And both those short-term sentiment lines down to extreme lows and have been at pretty strong lows, again, like the S&P, for multiple days. And we're 3% below, 3.5% below the moving average now, which is obviously the furthest away we've been, and is in the bottom 10% of the range, of the 52-week range. When you look at the highest point, which is right here, and the lowest point, which looks like it's right here, then obviously we're a lot closer to the lowest point, to the tune of, like I said, that 10% mark. So pretty strong moves. Obviously, I talked about this in the intro, with what's going on overnight, with the significant decline of more than 1% already that we're seeing. If assuming that we gap down tomorrow. Now, a lot of times when we get what is perceived to be significant selling overnight, it typically leads to either that gap to already be filled by the time the market opens, or for the gap to get filled as the market opens, once the volume starts to kick in. So I see a lot of tweets on like Twitter and talking about how tomorrow's going to be a bloodbath, and it's like a lot of times I've seen a lot of times where overnight it talks about the market being a bloodbath the next day, only for the next day to actually rally and fill in. And sometimes even, like I said, before the market even opens, it's already rallying. So wouldn't be surprised if that was the case tomorrow, despite already being down as much as it is here so far tonight. Let's take a look at the weekly chart. So we only got one more day left, but you can see pretty strong bearish candle, pretty decent size as it is, at 2% there, and you got the red arrow. So obviously if you don't believe we're in an intermediate decline, you should believe it now at least. We're below the 50-day moving average. The 8 and 17 are below the 30. The MACD is down. Stochastics is at pretty extreme lows. The MACD histogram is pretty low. It's lower now than what it was in any other period in the past year. So more of a decline than what we even saw over here from a momentum standpoint. You saw I didn't show the 3 red arrow chart, but you can see the 3 red arrows, and you can see the histogram turning up on both the Russell and the S&P, and has been now turning up on the Dow for a few days. Now let's take a look at some of these other oscillators. You can see the DMI is relatively bearish. Again, we're above 25. We're not above 30, but we're above 25 and we're below 20 far enough to where the ADX is rising above 20, hence the light pink shading. But again, that negative is not very high, so it's kind of hard to get light pink shading or even dark pink shading unless that ADX, that negative indicator, gets a lot higher. As you can see here, the first leg lower, which is kind of similar to what we're getting right now, it didn't go up above 30, you can see how weak that initial decline was. So kind of seeing something similar here, unless again tomorrow things change on that. We go up higher. We're obviously below 40 on the RSI. We're still below minus 100 on the CCI. We've been below minus 100 now for quite a while on the CCI. Again, the question will be, are we going to be below it long enough to have, well, we are negative now, so we're at least below zero. Are we going to be below minus 100 long enough to get this down to minus 102 and basically stop the bullishness that we've seen over the past with this 3-week decline? If you take a look at the Ichimoku cloud, again, we are intermediate trend strength, which tends to be about the extent of these intermediate declines when they are just pullbacks. If they were to turn into something more, ultimately they can turn into, you can see they can turn into something more to here. They can get to at least, if not mature trend strength, at least pretty darn close. And so, and you can see we got above 80 down there on the noise balance. But, the first leg lower, as I mentioned, when we kind of just barely got into the cloud and we bounced back up, this is about the extent that both these indicators got to. So you can see we're probably pretty close to the end of the trend. Again, barring, a significant catalyst, sparking more risk aversion, like we're seeing kind of overnight here. We are still pushing against that lower band. The bandwidth is rising. The bandwidth is outside the Keltner channels. The momentum is increasing. And we are another day below that lower Keltner channel. So 2 days in a row below that lower Keltner channel. And again, in the lowest quartile of the Bollinger Band width. So you can see how, it's a clear trend. We got a new low today. You're already down a little bit before when the after hours trading ended, and we'll see what happens when the extended hour trading begins in the morning. But again, a new 4-week low point. That means that red line's still at 100. No new high point, of course. So that high point's just going to keep ticking away over here. So about another week before we hit zero, and then that's when we can say, okay, we can start looking for the end of the bearish decline. From that perspective, right? Remember, we don't have to go down for the green line to go down. As long as we don't get a new high, then the green line will keep working its way. So we can actually go up a little bit, and the green line can still keep working away to the downside. You can see by the time we hit zero here on the Arun indicator over here, we had already bounced up that much. Off of the low. So we don't have to wait for it to hit zero before we start to bounce up. But once it does hit zero, there's a good chance that we may have already formed the low point. Good chance, right? If it's just a small pullback, a normal typical pullback, and that doesn't turn into a correction, of course. Today's volume and trading range were pretty much average. We were right on the average on the volume. Smidgen below the average on the ATR, so pretty much right on the average for both those indicators. We're still above the 1% mark, but we're not above. Again, just for some context here of what generally happens, because this one's not kind of the norm. But when you get your typical intermediate declines, you do hit it right around the 1.5% mark, if not closer to 2%, like we saw in some of these other declines. But at least a 1.5% mark. And so obviously we're not to the 1.5% mark yet. We didn't quite get there last time. We got up to over 1 1/3, and we'll see if that ends up being the case here. This would actually be even small. Now on the first leg lower, we did get to about this level by the time we started to bounce up, and volume had come up and kind of petered out, and we'll see if that ends up being the case again this particular go around. If you take a look at the volatility, obviously, it's going to be dramatically different here tomorrow. But we ended the day with the VVIX below 96, just barely, but coming well off the above 100 peak when we were up here right around 110, 109. The VIX is also kind of relatively low, still at 18, finishing above 18, but that's still a pretty low number, obviously below 20, below the 100% mark relative to the VXV. Still above moving averages, right? When you look at it above its moving averages, we're still easily above. In fact, the 30-day now has crossed above the 200-day. So we are clearly, we did get that briefly over here, but that's an indication when you are in a new volatility regime when the 30-day crosses above the 200-day. Right, that generally means, again, unless it's kind of a temporary one like this, or like this over here in 2019. Let's, if we were to, by the time we get up above it, if we're already falling back through it, then there's a good chance that can be temporary. Otherwise, like I said, it can start a new regime higher of bullish volatility that can last even through ups and downs. The trend higher can last quite a bit of time. Again, would be more associated with kind of a correction period rather than your normal typical intermediate pullback. All right, now let's take a look at what's driving the price action today. Over the past 3 months, you can see again still rising in the strong dollar, rising commodities, rising yields, and yet stocks are still pretty okay over the past 3 months. So they've been losing here lately, in real estate especially has been losing here lately. And you can see gold is really taken off. That was not a function of 2022. So this is kind of like a fourth head for the monster that we've been talking about. Because really what you see here, and I don't know if TNX hasn't been updated again, but if you look at like commodities here, pulling back, not trend changing on the pullback, but pulling back from, now below the 17-day moving average. Again, when there's a gap between the moving averages, they tend to fill in that gap, but not necessarily break through the next moving average. That's why breaking two moving averages at the same time tends to be, especially when they've converged for a while on top of each other, tends to be the more dangerous than what we're seeing like right now here. Same thing with the dollar index. It had pulled back a couple of days ago, bounced back up today. And you can see it started up a little bit higher here so far tonight for tomorrow's session. But the MACD is pretty strong. The histogram's already rolling over. So, the biggest momentum move to the upside is probably done with the MACD. And at best, we're probably going to have a convergence higher, where we might still continue higher, but just kind of more slowly. But that's, those have been the biggest issues. Those have been the biggest reasons why. Here's a TLT. You can see that the that it is down. It is moving lower. It's below the 8-day moving average. They're all moving lower. In fact, the 30 is crossed below the 50. The 50 is crossed below the 200. So you're kind of back in death cross mode, even though you were just kind of barely in golden cross mode there previously. And we came off of that point of control, off the 200-day moving average, still moving lower. But again, you wouldn't expect that we'll move considerably lower. Remember, the 10-year yield is going to be bound by where that 2-year yield is. I don't think you'll see the 10-year yield exceed the 2-year yield, because if the 10-year starts to move up that much, you'll start to see rate hike expectations start to creep up again. At least price out all the rate cuts that we had been pricing in, which would make the 2-year yield rise up. And then, of course, with more rate hikes, you could get the 2-year yield actually go up higher. So that's the kind of environment that a 10-year yield would rise up past the 2 years if we're that inflationary. But we'd be to that point where the Fed would start to consider raising rates again. And I don't think that's going to happen. And if it did, it wouldn't happen anytime soon. Here's your McClellan oscillator. We had been below 100 for a couple days in a row there. Yesterday we got it to minus 91. Today we're at minus 80. So these are pretty strong levels for the McClellan oscillator. We are below the 500 level. We're at 200 now on the summation index. Again, working below zero would really kind of put us into pullback mode. And we're not very far away. We're not going to get like another day of 100, most likely. Who knows? But most likely, because usually when we get days below minus 100, especially consecutive days like that, that kind of marks the low point. That's why, again, I think we are, again, barring how we respond to this overnight selling, which I don't think will probably hold up by the end of the day, by the beginning of the day tomorrow. But barring that, you're most likely going to kind of bounce off of these lows because, again, of how oversold we are, and not how oversold we are too in terms of breadth. If I were to take a look at the breadth here, remember how the breadth was just really, really bad and changed so dramatically so fast. This is the sentiment from bullish and bearish sentiment of the difference between the bulls and bears on the AAII investment survey. You can see it dropped to 4, so we dropped well below those averages, and we haven't switched to 0 yet, to where there's more bears and bulls. But that's a pretty big drop after multiple weeks of being pretty darn high here. If I were to zoom in, you can see it a little bit better. We've been above 10 for weeks and weeks and weeks and weeks. Again, this is a difference in percentages of respondents that are either bullish or bearish, and neutral would be the third option that we don't look at here on this chart. But we are below. You can see for the first time in I don't know how many weeks. It's been quite a while since this week. So it's been since the beginning of November, that first week in November, when we started the intermediate rally, that we were actually above those moving averages, because we had been below it there during most of this decline. Again, at the start of the intermediate decline started when you got below that moving average there. Well, here we are last week getting below the 10-week moving average, and then now this week getting below the 40. So you can see how clearly sentiment has changed. But I told you the breadth was really bad. Here's the number of new lows and the net new highs and lows, or net new highs, excuse me, is down there. The difference between the new highs and new lows is down to minus 273. The average is starting to falter. It's still positive, but it's starting to falter there. Again, another sign of intermediate decline, intermediate weakness. The number of stocks above the 50-day moving average actually rose today, so we were flirting with getting below minus 150. We didn't quite make it. You can see here when you look at this is where we're looking at 10-year yield, and 10-year yield up to 4.65%. But if you look at on the daily chart here, so there's your yield back up, kind of rebounding what we saw yesterday. But if I take a look at the Qs relative to IWM, again, you can see a pretty sharp drop. Now, we're still above moving averages, but and I've always said that, especially considering that the correlation's negative here, that a drop towards the 200-day moving average might actually be pretty bullish for the markets. But a break of the 200-day moving average would not be, right? So this was actually not bad. This was relatively bullish for the markets when we made that run below the 50 and below the 30 down towards the 200. And then, of course, we rebounded, and the stock markets did too, so went back to being positive. The normal correlation is this ratio to be positively correlated with the S&P. So that's why I say if we start to break down, especially if we break the 200-day, and assuming that this correlation gets back to being positive by then, obviously would not be the best sign for the market, as that rotation continues to rotate out of favor here. Here's the last 5 days, where all the major sectors are, XLK and XLC. Here, let's come all the way over here. Let's fit it. There we go. XLK and XLP. XLY is actually improving. XLP is improving as well. But you can see like energy is losing a lot of momentum. Materials is losing a lot of momentum. Real estate is losing momentum again, and in the lagging category. And you can see that right now there's nothing in the leading category. And the only ones really that's close, at least that has the highest momentum right now, is XLK and XLY. And instead of XLC, it's actually XLP. But XLK being there with those, remember that's the three biggest companies right now in the U.S. are XLK companies. Microsoft, Apple, and NVIDIA, these are all XLK. You can see Microsoft breaking down. We'll take a look at a trade on that here later. Apple's breaking down. NVIDIA's got dark pink shading and a red line. Broadcom's breaking down. Meta got that bull tag, but it's got dark pink shading now. Netflix is breaking down and has dropped even more on its earnings, down another like $30 or so. You can see dark pink shading across the board. Tesla's got another cluster. Amazon's even got a bull tag now, looking like it might be joining the party here in the dark pink shading and red line. Google's the only one that's holding up so far. So the market leadership is definitely working in the wrong direction If I were to take a look at how the sectors are performed, and we'll just take a look at today here really quick. Go to April 18th. You can see utilities, communication services, staples, financials. So a couple cyclical sectors, communication services, and remember Google's holding up pretty well, and then financials there. But utilities and staples are safety trades. XLK and XLY are both down at the bottom. Industrials and energy are also down. They're below zero and underperforming the market. Real estate and healthcare are outperforming. So it's, aside from, materials, financials, communication services, those are all three cyclical areas that typically are not associated with each other. Aside from those three areas, everything else that's outperforming or even positive on the day are safety trades. So obviously the market is moving towards that safety mode right now. All right, now let's take a look at our trade idea of the day. As I mentioned, we're going to take a look at Microsoft here, which just turned bearish, at least more bearish than it had been. It's still not quite as low as it was when you had dark pink shading and a red line, but 3.5% below the moving average, and you don't have that. I mean, you finally do have the dark pink shading. The red line will come when the moving average turns lower here. You can see the intermediate line is crossed below the chart's midpoint. The short term, it looks almost exactly like the S&P 500 and the Nasdaq's chart. Again, considering this is the biggest company that's out there in the S&P. Obviously, a bearish pattern here. You can see, and you're going to see a lot of very similar patterns here, like bearish pattern. There's the S&P, and here's Microsoft. So it looks very similar there. If you look at the three green arrows, there's the S&P 500, and then there's Microsoft. Again, breaking below the 50, working down towards the 200, a little bit of a gap in volume there that it can work with. Earnings coming out, of course, here after April expiration as we head into May expiration there. Let's see here. Try this again. There we go. The DMI, if you look at the DMI, the ADX is rising. Oh, excuse me, that's the S&P. Here's the Microsoft. Again, looks pretty similar. You're above 25 now. It's a little bit late than what the S&P is in terms of just forming the bearish pattern. Above 25, below 20 on the negative indicator. Looking at the RSI and the CCI, there's the S&P, and here is the Microsoft. Again, very similar. Below 200 though on the CCI for Microsoft, below 36. There is no trend yet formed on Microsoft. I said we are not quite below -1. We haven't gotten above 50. We haven't had a bearish move on Microsoft since this decline of last summer that we saw in the markets itself. And then if you look at the Bollinger Bands and the Keltner channels, you can see we are below the lower band, the lower Bollinger Band. So we broke below and closed below the lower Bollinger Band. That bandwidth is rising. It has not crossed out of the Keltner channels yet. Probably one more day away from that happening. And we also closed below the lower Keltner channels. So pretty significant move. But with that move towards the point of control, and you can see the move that we have down off the highs, but also move towards those lows, the value areas right here, the point of controls here. I thought I'd decide to do a iron condor spread where we take a look at Microsoft here and then sell the low 20s on the delta on either side, buy one strike away for protection, and then you can see that sets up this trade with a full position size. Again, don't have to worry about earnings, or I have to worry about earnings. But if you look at where my break-evens are, and you can look at other earnings announcements, we don't get significant moves on Microsoft. It's just too big to get a dramatic move. And if I were to break down more, we got the 200-day moving average here. You got the value area. You got that pretty decent sized volume node, all acting as a support. On the upside, there's some room up to the upside for it to get up to about 437. Again, the high point right about 432. So I have some room for it to go up to new highs if it were to continue to trend higher into that May expiration. Otherwise, if we just kind of build out some volume up above the value area, a volume node up here, that's kind of the point, especially as earnings goes, as we go through earnings and volatility. This is a negative vega trade. So you can see that if once volatility drops with the earnings announcement, that purple line will move up towards the green line, which is exactly what we want to see. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forum. Open up any new thread there with any questions or comments that you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join our website at marketscholars.com. Follow me on Twitter and Facebook as well. Have a great rest of your Thursday night, everybody, and we'll see you all next time.